morning and welcome to RSM Tax Summit Week 2021, Tax in Motion. We have an incredible week of tax programming planned for you and look forward to you joining us the entire week long, both here in our webcast and also in our virtual environment. Before we begin, I'd like to cover some housekeeping items. To download a copy of the presentation, visit the resources list to the right of your screen. To ask a question, type your inquiry into the Q&A manager to the right of your screen. Feel free to submit your questions at any time during today's presentation. For technical assistance, click the Help widget at the bottom of your screen, submit a question through the Q&A panel, or try refreshing your browser. Welcome again to the first session of RSM's Tax Summit Week 2021. Our first session for today is Federal Tax Policy in Motion. At this time, I'm pleased to turn our call over to James Alex. James?
Thank you. Thank you, Allison. Great to be with you all. Hope everybody had a good weekend and a good Halloween. It's fun to be back with you all for another Tax Summit, Tax in Motion, and especially engaging to be with Dave Cotter. I am James or Jim Alex. I'm head of go-to-market for RSM US and Canada Tax, and also I'm a senior leader in the tax policy group. I'm here today with Dave Cotter. Dave is our head of the Federal Specialty Tax Practices. Dave has an esteemed history, which I know well, because Dave and I have been working together for some time. Dave is before joining RSM, Dave was Assistant Secretary for Tax Policy at U.S. Treasury. That is the number one tax position in Treasury. Dave was there for 4 years under the prior administration, where he led the efforts with regard to tax reform implementation and also the amazing efforts by Treasury during the height of the COVID period. Dave, while as Assistant Secretary, he also served for a year as IRS Tax Commissioner. He is singular in that accomplishment. There's nobody else who's been both IRS Tax Commissioner appointed and also Assistant Secretary for Tax Policy. So it's a unique and singular accomplishment by Dave that he held both roles at the time. And I had a chance to work with Dave. He's an incredible leader. Before that, he was a leader for many years in Big Four tax practice. And before that, he served in Senate Finance and was a legislative counsel for several years and has a lot of experience up on the Hill as well. So with that, Dave, I'll turn it over to you to lead the conversation. If you don't mind, once in a while, as we get a question or two, I might interrupt you with that, but hope that's okay, and have a little bit conversational this morning as we walk through some of the major developments with regard to tax policy.
Thanks, Jim, and good morning, everyone, and welcome to Tax Policy in Motion. If ever there was a session that was appropriately titled, it is this one. There is a lot of motion here in Washington with respect to tax policy. The tax legislative process and the legislative process in general is always a messy, unpredictable process, and the Build Back Better legislation, also known as the Reconciliation Bill, is no exception. Last week was a particularly confusing week, and so over the next hour, hopefully we can try to simplify things for those of you attending this session and talk about a path forward. But let me do something a little bit unusual and start with a prediction. A lot of people are focused on what's going to happen. And obviously nobody can see the future, but I will predict that there will be a tax bill this year, that it will occur somewhere between the middle of November and the middle to the end of December. And I make that prediction primarily for two reasons. First, there are two pieces of business that need to be taken care of here in Washington between now and the end of the calendar year. The first is funding the federal government, and that is something that has to be done by December 3rd. If that's not done, then the federal government will shut down. The Republicans have said they do not favor a government shutdown and are willing to work with Democrats to keep the government open. But still, December 3rd is a pressure point. More than that, though, sometime in December, the federal government will hit the debt limit, which is the limit on the ability of the federal government to borrow to keep operations running. And that operations is not just funding the federal government, it's paying tax refunds to individuals and businesses that are owed refunds. It's making grant payments. It's paving roads. It's almost everything you can think of that the federal government spends money on. Sometime in December, the federal government is going to need to borrow money. More than anything else, I think that is a primary factor. So I said there were two. That's one. I don't think the continuing resolution is the other. I think the other is the desire on the part of Democrats to go into next calendar year, into 2022, with some significant legislative accomplishments under their belt. And they are viewing the infrastructure bill and this Build Back Better plan, so-called reconciliation bill, as the ways in which they can achieve those significant legislative accomplishments. So again, I can't guarantee it. No one can, but I think it is a virtual certainty. There will be tax legislation this year, and it will be sometime either from the middle of this month through probably the third week or the end of December. Now, we're going to spend a fair amount of time in the next hour talking about two bills that are before Congress, one that came out of the Ways and Means Committee and one that was being put together by the Rules Committee last week. Although we're going to spend most of our time talking about those bills, what you'll see is not a done deal. There were extensive negotiations being conducted here in Washington over the weekend with respect to a final tax package and a final spending package for the Build Back Better program. So as we talk, there are discussions on Capitol Hill continuing with respect to the content of the Build Back Better plan. For those of you who are interested in anything we talk about over the next hour, during the following week, this week, what we talk about will be woven into the content of these sessions. So if you hear something this morning that you weren't aware of or that strikes your interest, you will be able to find a session sometime this week to drill down more deeply in that topic. The last thing I'd say is that between now and final passage, there will be a lot of noise and clutter in the system. And the bill will be dead 100 times, and it will resurrect itself 101 times. And you can waste a lot of time following the ins and outs of this bill in great detail. I would encourage you to rely on your tax advisor to help sift through all the noise and the clutter over the next couple of weeks and try to identify for you what's most significant for your business and your personal situation. So having said all that, let's talk about some specifics. First of all, the Build Back Better plan has two components to it. It's got a spending side to it, and it's got a tax side to it. On the tax side, there are some tax reductions, which are tax credits primarily for low-income individuals, a child care tax, a child credit, and some other provisions, and a lot of climate change tax credits and incentives. What we're going to spend our time on here for the next hour are the tax increases, since they will affect more of you on this WebEx than will the tax reductions. The Republicans have made it clear that they don't support the Build Back Better plan. What that means is that in order to get this bill through the Senate and avoid a filibuster, the Democrats have to use what's called budget reconciliation. Budget reconciliation plan allows the Democrats to pass legislation with a majority in just the House and the Senate. While it has its advantages, there's some disadvantages to using the budget reconciliation process. One is that you cannot reduce federal receipts outside the 10-year budget window. Another is that you cannot include in the bill items that have a minimal effect on federal spending. And so there are some limitations that the Democrats are going to have to live with, having decided to use the reconciliation process. But they are well aware of those limitations and are fashioning tax increases to fit within those constraints. So what's the status right now? Well, let's start with the box at the top here in the center. Earlier this year, Treasury issued what's called a Green Book. That was a collection of tax proposals, reductions, and increases designed to fund the administration's spending initiatives. Based on that Green Book, if you look on the left-hand side of the slide, under the House of Representatives, you'll see the Ways and Means Committee produced a bill in September based on that Treasury Green Book that contains about $2.1 trillion of tax increases in it. We're going to spend a fair amount of time in the remaining time in this session talking about the Ways and Means Committee bill. Then last week, the administration released, going back to the center box at the top, the administration released a framework for a tax bill. That framework was incorporated in a Rules Committee bill. And so we're going to talk about what's in the Rules Committee bill. We're going to talk about the differences between the Rules Committee bill and the Ways and Means Committee bill. And I'll say up front and encourage you to remember, this is not a done deal. These bills are useful as benchmarks, and the provisions in these bills are very likely to be included in a final tax bill. There may be provisions that are dropped, and there will, I think, clearly be provisions added. And the main reason I say that is if you look at the right-hand side of this slide, there's been no formal action in the Senate. There have been plenty of discussions behind the scenes between the House and the Senate, and the process for including the Senate is not clear. So what I mean by that is the House, especially the progressives, would like an agreement that the bill that's passed in the House will go to the Senate for an up or down vote and no amendments will be offered. In order to do that, you have to negotiate an agreement with the Senate in advance of final passage by the House. So far, most of the negotiations with the Senate have been with Senator Schumer, Senators Wyden, who is chair of the Finance Committee, Manchin, and Sinema. And I'm sure you've heard plenty about those negotiations. The fact is the Senate itself has taken no formal action. It is exceedingly difficult to get the other 48 Democratic senators to agree that whatever is negotiated by the 4 senators I just mentioned is okay with them, and that whatever Senators Schumer, Wyden, Manchin, and Sinema negotiate is okay, and they don't need to have a say. On the other hand, if the bill passes the House and goes to the Senate, and the Senate goes through full deliberations, this could go on for a very long time. So it's a major unsettled factor in the progress and how this legislation will proceed. And it's one of the reasons why it makes it so hard to make a reliable prediction at this point in time. So this slide we've already talked about, which is sort of the timing. I talked about December 3rd, the expiration of funding for the federal government expires. Sometime in December, the debt limit will be reached. That is a real and genuine problem, and is an action-forcing event. And then at December 31st, the expanded child tax credit expires, changes to the research and development deduction and interest expense come into effect, and there are some tax extenders that need to be extended. But that's really not what's going to drive the action on Capitol Hill. It's really the bullet point in the middle, plus the desire on the part of the Democrats to show significant action this year. Now, it may be that the elections tomorrow in Virginia and New Jersey either enhance the speed of action or slow it down. What I mean by that is some could look at the results and say, clearly, we need to act quickly to get this done. Others could say what the public is saying is we need to go slower and be more deliberate and more considered with respect to the decision. So I'm not sure the Virginia and New Jersey elections will be talked about a lot here in Washington and around the country, but I'm not sure they're the action-forcing events that the other two factors are that I just talked about.
Hey, Dave, let me interrupt for a second, if you don't mind. You've shared one thing else regarding the need to move fast. And if you could share that bit of inside baseball with regard to the longer something marinates here in D.C., the less likely. Can you just give a quick thought on that?
Well, you know, the normal legislative process is legislation's introduced, there's a hearing in a committee, there's a markup in the committee, it's reported out of the committee, it goes to the floor of either the House or the Senate. And that's the normal process, and that happens in the House and in the Senate. The problem in today's world, given the ease with which communication can occur, is that the longer a legislative proposal sits in front of the public, the easier it is for opposition to that proposal to gather. And so it's frustrating, right? Because people want to see what might happen. On the other hand, the members know the longer they let something sit out there, the greater the resistance is going to become. And so that's why you see, right, the framework from the White House comes out Thursday morning, Wednesday night. The Rules Committee's got a bill ready to go Thursday afternoon. And in part, Jim, last week was an effort to get a vote on the infrastructure bill before President Biden went to Europe. And the progressives have been saying, we're not going to vote on the infrastructure bill until we see the language on the reconciliation bill. So the White House said, you want language? We'll give you language. And so they put out the framework, and the Rules Committee put together the language, and to which the progressives said, well, we see that, but we're not sure that's all the language. And so it was an interesting attempt to try to move the legislation, but it didn't work. So right. Anyway, now we've got two bills, and what I will say is no matter which of these bills or which pieces of these bills are included, there is a firm commitment on the part of the administration and the Democrats in Congress to not add to the federal deficit or debt as a result of this bill. And so a basic principle as we go forward is that the spending is going to equal the taxes. All right, let's get to specifics. And we'll start with the Ways and Means Committee bill. So these are the changes in the Ways and Means Committee bill with respect to individuals. There are a few other small changes, but these are the big ones. And I divided the changes into rate changes and non-rate changes. So you can see the proposal is to increase the long-term capital gains rate from 20 to 25%, to increase the top individual rate from 37 to 39.6, to impose a 3% surtax on modified adjusted gross income greater than $5 million. So note that that's not a 3% surtax on taxable income. It's on modified adjusted gross income, which is basically adjusted gross income minus interest expense. And so you cannot, a high income individual could not reduce their obligation to pay this tax through itemized deductions like large charitable contributions. And the last, which was not a rate change, was to increase the carried interest holding period from 3 to 5 years. Well, the Ways and Means Committee forgot to check with Senator Sinema before they put their bill together. And Senator Sinema has taken the position that she will not support rate increases. She'll support tax increases, just not rate increases. And she has given a very clear and, depends on your point of view, but to some compelling argument as to why she doesn't think rate changes make sense in the current environment. So the Biden framework, which was basically put into legislative language by the Rules Committee, drops the rate increases for capital gains, the top individual rate, and the surtax on modified adjusted gross income greater than $5 million, but imposes two new surtaxes: a 5% surtax on modified adjusted gross income greater than $10 million, and an 8% surtax on modified adjusted gross income greater than $25 million. Now, sometimes you see that as a 5% surtax on modified adjusted gross income greater than 10, and 3% more on 25. But I just put the two together. So you put that 8% together with a 37% top individual rate, you get to 45%. And you put that together with another change I'll talk about, expanding the net investment income tax rate at 3.8%, and you can get to 48.8% under the Rules Committee bill pretty easily. And the line I often think of, which takes me back to the days when I used to work on Capitol Hill, for a member of the Senate Finance Committee. In those days, for part of my time down there, a senator from Louisiana, Russell Long, was chairman of the Finance Committee. And there are all these sayings that are attributable to Russell Long. But one day we're sitting in the committee, and Senator Long had a line which I've always remembered, which was, he didn't think that any American citizen should be the minority holder in their paycheck. That it shouldn't be that the federal government had a greater interest in the paycheck than the person who was earning the money. And so this gets you up on the federal level to 48.8%. The other change that's made is the last line on this chart, and that is there is currently a rule which disallows the ability of taxpayers to use business losses to offset non-business income up to the extent of greater than $500,000. So in other words, you can take business losses and offset wage income up to $500,000 a year. That is scheduled to expire in 2025. Under the Rules Committee bill, that would be extended permanently. That raises a fair amount of money, and we'll talk about that before too much longer. So anyway, Rules Committee bill, surtax, and this change on the ability to deduct what are called excess business losses against non-business income. Estate and gift. Let me spend a minute on the estate and gift area. The changes proposed by the Ways and Means Committee are revolutionary in their scope. The first line, reducing the exemption from $12 million to about $6 million, is not revolutionary. That's scheduled to occur after 2025 already. This bill, Ways and Means bill, would accelerate that to 2022. What is revolutionary are the changes in the grantor trust rules. Grantor trusts have been the backbone of estate and gift planning for the last few decades. Many estate and gift plans are built around the existing grantor trust rules. The Ways and Means Committee bill would make significant changes here. For one, grantor sales to grantor trust would become taxable in certain circumstances. They would change the valuation discount rules. For example, if you had publicly traded securities in a closely held business that was conducting a business, and you were going to have a discount because it was closely held, or because you didn't have a majority interest. Publicly traded securities would be valued at full fair market value. And there are a number of other changes which are significant. That has created a lot of concern among individuals who would be subject to the estate tax. Rules Committee does not have a single item in it in the estate and gift tax area. Does that mean the estate and gift tax rules are not going to change? No. It seems to me something is going to be included. I don't know exactly what it will be, but I believe there'll be something in the estate and gift area when we get final legislation.
Yeah, Dave, let's just pause for a second. We get so many questions in this space. So even though for the moment it's out, you're thinking something will come back in, the extent and scope to be determined, but you're sensing something may come back in.
I do, Jim, and again, I can't guarantee it. It's just that there is so much focus here in Washington on individuals who have accumulated substantial wealth that it's difficult to believe the final legislation is not going to include anything that affects individuals who have accumulated substantial wealth over their lifetime. I don't know, but that's why I think there'll be something.
Do you think it's something more likely or easier, like just the exemption amount or the rate?
The exemption amount is really easy, right? Yeah. So I think just dropping the exemption amount early is really easy to do. I don't know that they'll tinker with the rate, but I do think some of the Ways and Means Committee bill provisions, which are very popular with Democrats on Capitol Hill for the most part, would be the leading candidates if I was going to try to guess what might show up again in a final bill.
Okay, all right.
So let me move on to corporate. Again, the Ways and Means Committee bill was very rate intensive when it came to the corporate tax changes. It would increase the top rate from 21 to 26.5%. And by the way, each 1 percentage point increase in the corporate rate raises about $100 billion over a 10-year period. So increasing a 5.5 percentage point rate increase raised $540 billion over the 10-year time horizon of the Ways and Means Committee bill. There was an increase in the accumulated earnings tax and the personal holding company tax to 25%. On the other hand, there were some rate reductions for corporations with lower levels of income, up to $5 million. Rules Committee, rate changes are out, and there are two new provisions. About in the middle of the page, you'll see a 15% minimum tax based on GAAP earnings on corporations with greater than $1 billion in profit. Now that has to be $1 billion in profit over 3 successive years. It's based on GAAP, and it's estimated that it would only affect about 200 corporations. Now, I'll tell you an interesting story that goes back to my days on Capitol Hill. I worked for the senator who introduced the original research and development bill back in 1979. And I was on the staff at the time, and the Treasury Department showed up and opposed the R&D tax credit. It was proposed to be a 10% across the board credit. And one of Treasury's objections was that they couldn't define research and development. And they said they didn't really care because even though R&D was deductible under Section 174 of the code, it was also deductible under Section 162 as an ordinary necessary business expense. But now if there's a credit, it really matters. And they tried to define R&D back in 1969, and they couldn't do it. So now 10 years later, they're objecting to the R&D credit bill that had been introduced. And so we went back and took a look at what definitions might be out there. Well, the Financial Accounting Standards Board had come out with Financial Accounting Standard number 2, definition of research and development for financial accounting purposes. So the next bill that was introduced included the reference to Financial Accounting Standard number 2. The Financial Accounting Standards Board in those days had a Washington office. Next thing you know, they want to have a meeting, and they say to me, whatever you do, please do not tie federal tax benefits or liability to financial accounting standards. Because the minute you do that, we're concerned that there's going to be greater pressure on the financial statements and the greater pressure on the Financial Accounting Standards Board and other accounting standards setters. And we're going to have a difficult time resisting that pressure. So we took it out of the bill. It's not in the R&D credit bill. And you really don't find much conformity between financial accounting standards in the tax code and financial accounting standards, GAAP and others. So now comes along a proposal. Well, we're going to base your taxes on your financial accounting statement. So it's interesting how things change over time. Anyway, that's estimated to raise $325 billion over the next 10 years. The 1% surcharge on public company stock buybacks is estimated to raise $125 billion over the next 10 years. So those two get you $450 billion.
Let's pause for a second on that. So Dave, two things. One is I was talking to somebody in the press the other day. I mean, that your point is going to put a lot of pressure on Treasury, right? I mean, it's likely that Congress, if they do implement the 15% minimum, they're going to leave a lot to Treasury to try to figure out. That first question. Second question is, what do you see as the status of R&D and the fact that we're moving away from immediate expensing come January 1?
Well, there is in the Ways and Means Committee bill, I'm focused right now on tax increases, but in the Ways and Means Committee bill, there was a provision which deferred the R&D change, which requires amortization of R&D instead of immediate expensing starting next year. That would be deferred till 2026. There's a lot of support on Capitol Hill, both among Republicans and Democrats, to defer that change from expensing to having to write it off over a 5-year period. I expect at some point that will happen, whether it's in this bill or not. I don't know, but there's a lot of sympathy to deferring that change. So I think that will happen. So let me move on to partnerships and flow-through entities. Ways and Means Committee bill made a lot of changes in this area. Section 199A, which is the 20% deduction that flow-through entities are allowed, which was an attempt in the Tax Cuts and Jobs Act to equalize the rates between corporations and flow-through entities. The Ways and Means Committee would place a cap on that deduction of $500,000, which is basically $2.5 million of flow-through income. Second, they'd increase the carried interest holding period from 3 to 5 years. I mentioned that earlier. A couple of small changes, but could be significant for some on this webcast. Worthless partnership interests would now become capital losses. Under current law, it's possible that in certain circumstances they could be an ordinary loss. This would make clear their capital losses. Interest deduction limitation. This is an interesting one. 163J, the interest deduction limitation that was enacted as part of TCJA, would be applied at the partner level and not the partnership level. Depending on your personal circumstance, this could either be good or it could be a disaster. It really depends on your personal circumstance. So that's significant. And not only that, the Ways and Means Committee bill would say to the extent that disallowed interest can't be deducted for 5 years, it's permanently disallowed. Finally, the expansion of the 3.8% net investment income tax to all net investment income derived in the ordinary course of a business. This would apply to taxpayers with more than $400,000 or married filing jointly taxpayers of $500,000 in taxable income. That's a big number, and I think that raises $250 billion over the next 10 years. So some significant changes. So what about the Rules Committee? Well, no change to 199 capital A, no change to carried interest. The worthless partnership interest provision stays. The interest deduction limit stays, but they get rid of this complete disallowance if you haven't deducted it within 5 years, and they keep the 3.8 expansion. So again, rules back. Probably most significant for many of you on this WebEx is the first line on this, no change in the 199A deduction. But again, we'll see where we end up with this one.
Hey, Dave, before we move off of this frame, can you just step back for a second? What, with regard to the SALT deduction limitation that came through with TCJA and potential relief, what are you sensing right now with regard to some mitigation of that?
The SALT changes are not in either bill. It's clear in order to get this through the House that some accommodation is going to have to be made to the SALT for the SALT deduction. What's been discussed most frequently is that the cap would be removed for 2 years, and 2022 and 2023 is what's being discussed right now. And then the cap would come back into effect in 2024 and 2025. It's scheduled right now to expire in 2025. But in order to pay for the 2 years that the cap would be removed in 2023 and 2024, 2022 and 2023, they would extend the cap in 2026 and 2027. That way it's revenue neutral. And by the way, the SALT cap costs about $90 billion a year. So if you remove the SALT cap for a year, it's about $90 billion, 2 years, $180 billion. If you're trying to keep the tax increases minimized, this is an easy way to do it. It's revenue neutral within the 10-year budget window. You get the 2 years, you live to fight another day and see what happens in 2 years.
Right.
Again, I'm not sure that's what will actually happen, but that's what's being discussed.
I get it. Yeah, people don't realize it's a lot of money, the state and local tax deduction limitation. And that's a lot of the driver behind the change. And so, as you said, if they mitigate it, it's going to add up with regard to their trying to have your original frame of taxes equals spending. It's going to affect that equation. It
is. And it tends to benefit higher income individuals as well.
Right.
So let me talk about transactions. There's 3 items here. Section 1202 stock. Taxpayers with incomes greater than $400,000 would only be able to exclude 50% of the gain. In other words, for those taxpayers, the 75% exclusion and the 100% exclusion would no longer be available. For taxpayers below the $400,000 threshold, the full exclusion, 75%, the 100% would be fully available as they are today. This is an interesting one, the wash sale rule. This is the rule that says if you sell stock at a loss or certain securities at a loss and you repurchase the security within 30 days, you can't deduct the loss. They would extend that rule to commodities, currencies, and digital assets. And there's another rule called mark-to-market, or some call constructive sales, which mark-to-market certain securities. Those rules would be extended to digital assets, and the Rules Committee keeps all three. So no change on any of those. So for those of you who are 1202 advocates, it looks like this is a provision that has some staying power in the final bill. So let me talk about the international provisions next. And this is an exceedingly complicated area. And I just want to talk about the key concepts. There are sessions later this week that will drill down into what's on this slide and the next slide in much more depth. So if you're interested in these changes, I would encourage you to attend those sessions. GILTI, which is really a minimum tax enacted, excuse me, as part of the 2017 TCJA. Right now, GILTI is computed on an aggregate foreign basis. So you put all your foreign operations together, and you make you do your computations, including your tax credits. GILTI would be changed so that it would become a country-by-country computation. Second, what's called QBI, Qualified Business Asset Investment. The deduction that you get, this is basically, since GILTI was designed to tax foreign intangible income that's not being taxed appropriately, there was a deduction allowed equal to 10% of your your investment in foreign tangible assets, saying, well, if the goal is to tax this extraordinary rate of return abroad, then we're not going to try to tax a return on your tangible assets. You can like the theory, not like the theory. That was the theory. Anyway, that was a 10% of your foreign tangible assets was a deduction. That would be reduced to 5%, and the GILTI rate would move to 16.5%. FDII, Foreign Derived Intangible Income, which is an incentive provision designed to encourage intellectual property to be developed and retained here in the United States, would have an effective rate of 20.7%, and the base erosion anti-abuse tax rate would be 10% for 2 years and then 12%. Currently, it's 5%. And again, these are really complicated areas that we don't really have time to drill down on. But just to give you a sense, in the Rules Committee, what the Biden framework and the Rules Committee does is conform what came out of the Ways and Means Committee to the global agreement that's been reached and has had a lot of press and media attention over the last couple of weeks with respect to the OECD initiative on a corporate global minimum tax rate. So changes still be a country-by-country calculation, which is what the OECD agreement requires. The QBI would be reduced from 10% to 5%, and the proposed 16.5% rate would be the 15% rate, which is this 15% global minimum tax rate that you hear people talk about, which is different from the 15% financial statement-based minimum tax that we talked about a few minutes earlier. Easy to get confused. FDII, they'd reduce the rate on that from over 20% to 15.8%. The BEAT rate would gradually increase, so start at 10% next year. There'd be a series of tax credit changes and computation changes. Changes the foreign tax credit, just like Ways and Means. The two bottom lines are new. The Rules Committee bill basically has a provision which is intended to keep companies that have foreign operations from skewing their interest deductions to the United States. So this basically says we're going to limit the amount of interest you can deduct that your worldwide group incurs to basically an amount that bears a ratio, a percentage equal to your U.S. income over your global income. And we'll give you 110% of that as a U.S. interest deduction, but that's it. So interesting. And then one that's getting very little attention, right now that you can use a territorial system, which is basically to say your share of foreign earnings of a foreign corporation that are passed through to you are not subject to U.S. tax. In TCJA, that applied to a 10% or greater shareholder in a controlled foreign corporation. Now it's only going to apply to the controlling shareholder. I'm surprised that hasn't gotten more attention, but it's in there. Retirement plans.
Dave, in the international space, that's one area where we definitely need to watch the Senate, right? Because the Senator widens interest with regard to international.
Agreed. That is next to the IRS reforms, which we'll talk about in a minute. That's the largest revenue raiser. And there is a desire to just tighten the rules with respect to foreign operations. Senator Wyden, who's chairman of the Senate Finance Committee, has had a great interest in this. And so I would expect to see more changes in that area before it's all over. Let me move to the retirement area. The Ways and Means Committee bill made some significant changes for individuals who have accumulated substantial retirement balances or high-income individuals. Basically, distributions would be required if someone's IRA and defined contribution plan balances, so 401k plan balances, profit-sharing balances, IRA balances are all added together. If they're more than $10 million, even though you're not age 70 and a half, you would be required to start taking distributions from those plans. Limitations on types of investments would be implemented. So you could not invest in you could not invest basically in stock of a company that was a startup that was controlled by the IRA owner. This is an attempt to prevent entrepreneurs in startup situations from putting stock with low value in the IRA. If the company is successful, it becomes very valuable. It's now in a tax-free vehicle, and many members of Congress don't like how big these balances have gotten. So they place substantial limitations on that. Limitations on Roth conversions and on contributions for high-income taxpayers. Again, sessions later this week. If you're interested in this, session should be very interesting. Rules Committee, interestingly, dropped all those proposed changes and only kept one area, which is there'd be a limitation on investments that could be put into these plans, but only with respect to DISCs and FISCs, which are domestic international sales companies and foreign sales companies. And so the owner of an IRA, who also owned a company that had a DISC, wouldn't be allowed to have that DISC owned by the individual. Very narrow. And I don't know who got who mad about the DISC and the FISC, but somehow this is the only provision that managed to survive the White House framework. So we're getting close to the end of my prepared comments, and let me talk about the funding for the IRS. And so, as Jim mentioned, I spent a year as the acting commissioner of the IRS. IRS budget in a normal year is about $12 billion. What the White House and the Ways and Means Committee have proposed is increasing the funding for the IRS by $80 billion over the next 10 years, which averages out to $8 billion a year. Well, if your average budget is $12 billion and you're getting a supplemental budget of $8 billion, right? Your budget's going up by 2/3. Now, if you look at this chart where the IRS funding is going, the second line, enforcement, $45 billion for enforcement. The rule of thumb for the IRS, which is pretty reliable, is for every dollar spent on enforcement and collections, federal receipts go up by $5. So that $45 billion, if you use the traditional 5-to-1 multiplier, would generate $225 billion of additional federal receipts. This is included in the White House proposal as raising $400 billion. I can't imagine that the congressional scorers are going to score this at $400 billion. So even at the traditional, right, 225, 400, there'd be another 175 billion that they have to look for to fund this bill if you're not going to add to the deficit as a result of the Build Back Better plan. And I'd also say the other point here is expect increased IRS audit activity starting about 18 months from now. It's going to take the IRS a little bit of time to hire people, to get them trained and get them deployed. And I'm not convinced that those audits, when they start, will be the most efficient audit that you will have ever been involved in. Again, it's hard to predict. I don't know how it'll all work. But the point I'd make is funding is in this bill. I've actually written a couple of op-eds. I think this funding is dramatically in excess of what the IRS needs and can probably effectively use. But anyway, it's in there. So this is just a quick overview. As I said, we were going to focus on the tax increases, and we have for the last 50 minutes. If you look at how much money is raised by the different provisions, this 15% corporate minimum tax based on GAAP, $325 billion, stock buyback, the 1% tax, $125, international, $350, this 5% and 8% surtax, $230, Medicare tax base, this net income investment tax expansion, $250, and you can see the others, IRS at $400 billion. And on the other side is the spending. So right now the bill stands at $1,850 billion, and we'll see where all that ends up. So if additional revenue is needed or there are changes made, what's likely to happen? Well, we used to have a saying when I worked on Capitol Hill and it was time to raise revenue, that it's time to round up all the usual suspects. And this list is the usual suspects. So a traditional corporate minimum tax, as you remember, corporate minimum tax was repealed in 2017. Individual minimum tax was left in place. The corporate minimum tax was repealed. You could bring that back. Additional changes in the foreign earnings area to get more revenue there. Executive compensation deduction limitations, expanding the limits for deducting executive compensation. Right now it's $1 million deduction limit imposed on certain individuals and certain businesses that pay individuals in excess of that. Expand the number of businesses maybe this is subject to, and maybe also lower that $1 million cap. Limit other deductions and credits. Change in the allowable partnership allocation methodologies. Tax based on asset appreciation. This was the billionaires tax that people talked about, which was marking to market the fair market value of assets owned by billionaires. Bank reporting. At the moment, that seems to be out, which is this new Form 1099 that would report gross receipts and into and gross payments out of bank accounts. That's been raised to $10,000 in the discussion. Very controversial. Right now, I'd sort of bet against it, but it's hard to know. And the state and local cap we already talked about. I just want to spend, Jim, before we close up, I just want to spend a minute on the OECD. And there's two pillars in OECD. A lot of discussion about this. Many of you, most of you on this webcast won't be affected by this, but it sure is attracting a lot of attention. It's really focused on the major global multinationals. There's two pillars, Pillar 1 and Pillar 2. Pillar 2 is the 15% minimum tax that we already talked about. Congress has to approve changes to the Internal Revenue Code to be in conformity with what's been agreed to. The objection you hear right now is, why should we change our law today when other countries may have as long as 10 years to adopt these changes? But it's in the package, likely to happen. Title I is likely to only affect 100 companies. And this is a change in how the international tax rules work globally. And it takes earnings above a certain level of these 100 large global multinationals, not just US headquartered, could be headquartered anywhere. And it reallocates the right to tax those earnings to other countries based on something other than physical presence. And so these are revolutionary, and they will continue to attract a lot of attention.
And we're going to talk about...
I think those are my prepared remarks. We can talk a little bit about the path forward, or if you've got a couple of questions you want to ask, we can...
Yeah, the Pillar 1, Pillar 2, we're going to talk about supply chain later in the week. Mike Fletcher is going to lead a discussion. Obviously, this is now another factor, right, with regard to the supply chain issue with concerning now a global minimum tax. The potential for, correct?
Right, absolutely.
Yeah. Yep. Okay, I think we have a frame. Let's go back. Why don't we advance one more, Dave? So,
okay.
I think bottom line again, back to where you started.
Yep. So, okay, Jim, thanks. So let me pick up on where I started, as Jim says. Thanks.
Yeah.
I think there'll be a final bill. And I think it'll be sometime between the middle of this month and the third week in December. And I've already gone through the reasons. There's a lot of talk here over the weekend. Well, let's get this through the House on Tuesday. Well, then the Rules Committee decided they're not going to meet today. So we probably can't get it Tuesday. Well, what about by the end of the week? I don't know. But the big issues, there are two, other than the infighting. The Senate hasn't really weighed in yet, or been given the opportunity to weigh in what I think many senators would think is a meaningful way. And the Joint Committee on Taxation hasn't officially scored all these tax provisions that we went through. So I had a chart which had numbers on it. Those are the administration numbers, right? And they're produced by economists in the Treasury Department. Capitol Hill doesn't often agree with those numbers. So Joint Committee hasn't scored it, and the Senate hasn't weighed in on it. So I still think there's work to do. But in the end, I think it's going to be a broad-based bill. I think there are going to be changes that affect high-income individuals, that affect businesses, both corporate and flow-through. I think there'll be significant international changes. I think there'll be changes in the retirement area. I think there'll be changes in the estate and gift area. I think you will drive yourself crazy if you read everything in the media over the next couple of weeks about what's in this bill and what's out of this bill. And I would encourage those of you on this webcast to rely on your tax advisor as sort of an interpreter to help you sift through all the noise and confusion that you're going to hear over the next couple of weeks. So with that, Jim, I think we're right about
thank you, Dave.
Leave it at that.
Yeah, terrific observation. I love it'll suffer 100 deaths, but 101 resurrections in the end, and that'll be sometime in December. So thank you. Okay, Dave, as you've heard me say, you're the best voice in private practice on tax policy, given your experience on the Hill and U.S. Treasury and the IRS. So terrific to have you here this morning, kicking off Tax in Motion. Stay with us all week, folks. As Dave said, we'll have insights on all these developments and much more. It's a terrific assembly of speakers and topics. And at noon, to follow up on what we have here, we'll have Selling Your Business in a Time of Uncertainty at noon Eastern Time. Please join us for that. Great discussion. Dave, again, thank you. Always enjoy being on a panel with you. And Allison, I'll turn it back to you.
Thank you so much to Dave Cotter and James Alex for kicking off Tax Summit 2021 week today. And as Jim mentioned, we have plenty of opportunity for you to interact with the entire RSM Tax team. You can visit any of the resources that we have available to you in this week's virtual environment, including the Tax Resources Center, the Tech Forum, and of course the Game Room. Make sure you are participating in the Jeopardy and Scavenger Hunt throughout the week for points and prizes. At this time, we're concluding this first presentation for today, and we invite you to participate in the following presentations for today's session. Thank you so much for joining us for RSM Tax Summit Week.